Hello, this is the chart profit video. This is from the pre-open today. We're looking at the E-mini S&P. The minor level we've been focusing on just recently is 25.73, which is the minor controlling price. And saying recently that a value area printed entirely below that level would be the first minor sign of weakness. Although that level was tested, that minor support was tested yesterday, the value area was printed almost entirely above it. And if we look at the current half-hour chart here for the E-mini, you can see today's session, which started with this first blue bar here, has found support at that level. I'm saying first value area printed below there would be the first sign of weakness. This is the pulse chart for the S&P, the spider at the top here. In the center we have a little breadth system running, which currently remains green, which is positive. Price momentum indicator at the bottom remains above the zero line, which is trend up. You can see on this daily bar there is quite a clear divergence going on, and should the price oscillator turn down, we'd expect the price would stall at least. We've noted many times that when the price oscillator turns down from an elevated level, it tends to get back to the 0 point, and it certainly didn't here, showing a strong trend up. And we've turned back up again here, but it's this current negative divergence which is the sort of feature which makes this a little bit different right now. So the momentum indicator at the bottom here just suggests that price is slowing. Until we see a value area printed below 25.73 on the E-mini, S&P remains in a strong price location. We've noted recently that there's been a number of extremes in the sentiment indicators. In last week's ebook released on the weekend, I noted a number of them here highlighted in red. Investors' intelligence, the net level and the ratio reached their highest since 1987. The market vein advisors poll 1 week previous to that reached 71. That was the highest since 2007. My version of the Ridex assets ratio reached 18.34 last week. That was the highest in the database, and the VIX closed at 9.14 the previous week. That was the lowest close ever. Let's just quickly update those. This is my version of the Ridex assets ratio. 2 weeks ago it looked like this, just broke above the previous high point, which was here. 1 week ago we saw it up here above 18, which is the highest in the database, a real extreme. Currently we're down off that level, but just the fact we got that high usually indicates that the upside is limited in the market, usually a warning. This is the bull fund assets in isolation. Just a few days ago we reached a real extreme here, and bear fund assets close to, well, it was just a few days ago here, the extreme low in bear fund assets. In the public poll this week from AAII, the bulls percent was unchanged at 45.1, that's the highest since January. Bears percent was lower at 23.1%, and if we look at the net figure, that's the bulls minus the bears. We run a 4-week moving average through that, that's the black line here. Currently that has reached 13.78, that's the highest since January. And here's those extreme levels in the investors' intelligence. This week, bulls percent reached 64.4, even higher than last week. Bears percent unchanged at 14.4, means the net, that's the bulls minus the bears, at 50, currently at the highest since 1987. And if we look at the ratio, that's bulls divided by bears at 4.5 times the bulls, and then the bears, that also is the highest since 1987. These are really extreme readings in the sentiment right now. Lipper US fund flows reported equity fund, including ETF inflows this week, $4.7 billion. Lifts the 4-week flow in black here a little, but not as high as we reached earlier in the year. So sentiment at an extreme, but I see thus far no real breakdown in price. Market remaining pretty resilient. The spider bounced back yesterday. Even this very minor controlling price at 255.19 has yet to be tested. We did note the pattern or the upward bias of the spider over the last few weeks relative to the small caps. This Russell 2000 ETF IWM, you can see that the small caps very clearly underperforming, so we have that negative divergence. We call it negative divergence between the large caps and the smaller cap ETFs. Tends to be a correlation between the S&P and the high yield ETF HYG, and you can see that's been tumbling the last few days. So we've talked about 3 negative divergences already, the S&P with the small cap index, with the high yield ETF, and also with its own price momentum indicator on the pulse chart. And if we look at the New York breadth chart through daily breadth indicators through Thursday, you can see the pattern again here, price at the top here, New York, and at the bottom we see various breadth indicators that I follow, and these are currently all diverging lower. We're also seeing some weakness here in the UK FTSE 100 index, closing fairly weak on this Friday for this week, and the German DAX index, after a really strong run up once it overcame its 8-month resistance here, again this week closing very close to the low of the week. Okay, T-bond ETF TLT quite sharply lower today and is actually stalled right now on our 10-month at 124.40. This dotted blue line a little lower represents the next kind of natural support. We've seen it proven here and here, which is the halfway from the low earlier in the year. Price below 123 would suggest a retest of the major down here at 119. Looking at gold here, GLD, the gold ETF, is churning at the moment, but it is holding above its major at 119.84. Found very obvious support at that point a few weeks back, and as long as the chart holds above that level, it's still in a strong price location in the longer term. Dollar index could work its way into a strong location if it can print some time above this level, which is 95.50. That's the major controlling price on this chart. As I mentioned last week, I use the 40-period Bollinger Bands that you can see on the chart here. When the chart pushes down into the lower Bollinger Band and then just corrects back to that central line and then comes off again, that's a weak chart. And just over the last couple of months we've seen the opposite of that, whereby we've probed up into the upper Bollinger Band and then come back to the central moving average and up again. So price action itself looks pretty positive, and I've seen a lot of comment re this potential kind of bottoming pattern here. I still think this major up here at 95.50, potentially strong resistance, but price printing time up here would put the dollar index back in a really strong position. Euro FX chart currently printing below the 1 year at 117.55, this red line, and again there's that potential reversal pattern. So right now we're printing below that neckline and below the 1 year. There's been a little bounce so far of this test of the lower Bollinger Band, and unless the chart prints back above that 1 year up here, it's in a weak position in the near term, suggesting possibility that we'll retest this major down here at 113.29. The pound, however, printing above 129.95, the 9-month here. So in the longer term it's in what I call a strong price location here, but I would prefer to see a clear pattern, a higher low above that blue dotted line, which is the halfway point off the Brexit high back over here, before assuming there's more strength in this chart right now. Finally, the dollar yen holding above its 2-year controlling price here at 111.30, and currently consolidating above the halfway from this high to this low, this blue dotted line, previously resistance at this point, and now consolidating above there, very close, but we're holding it. In the longer term, as long as we hold above this 2-year controlling price, all of this in a strong location. Okay, that concludes. Once again, I wish you a good weekend and thank you for watching.